Welcome back to Galaxy Grid, the weekly show from Galaxy Research about everything that's happening in crypto. I'm joined this week by Arjun Mohan, Zach Bacorny, and Lucas Chayan. Lucas joining us from somewhere across the pond. I don't know where, somewhere not in America.
Italy.
To me, it's merely binary, America or not. He is not in America. What a weekend. Here are the stories for this week. Leverage, Wipeout. At least $20 billion was wiped from futures markets Friday during one of the most violent liquidation events in crypto history. Trump's messaging at market close on Friday that he would add 100% tariffs on China was the spark. But what actually happened in crypto? Polymarket's big raise. Polymarket, the prediction market, raised $2 billion from Intercontinental Exchange. That's the owner of the historic New York Stock Exchange, among other things. It was the seventh largest equity investment in a crypto company and the largest private investment by a traditional Wall Street firm. What does it mean for Polymarket, prediction markets, crypto, and what does it mean for ICE and TradFi? What in the world is ICE thinking with this raise? New ETFs are coming. Well, once the government opens back up is the major caveat. TradFi is on the verge of gaining access to perhaps a dozen new crypto assets in the form of traditional ETFs. Which ones will be hot, which will flop, and what will be the impact on the existing ETF complex, which is basically just Bitcoin and Ether today. And lastly, Salomon Brothers dust attack. A huge report from Zach Bacorny and Will Owens from Galaxy Research examines one of the most bizarre Bitcoin transaction sets that we've ever seen. An unknown actor sending 40,000 op return messages to 2.3 million Bitcoin, basically saying either move these coins or prove you own them, or we will take constructive possession of them. It portends some kind of legal mumbo jumbo coming down in the future. We'll get into that with Zach. Before we get into any of that, I need to remind you to please refer to the link to the disclaimer in the podcast notes and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. Gentlemen, let's get started with the big story, the leverage wipeout. Like I said, at least 20 billion, according to CoinGlass, was wiped. Some estimates put it to 30 to 40 billion due to just exchange underreporting. What happened? What in the world happened? It's the biggest notional leverage wipeout in crypto history on Friday, right at market close on Friday. Binance was hard coding or using their own pricing for Athena or USDE. Is that at the epicenter here? That's what I'm seeing some people say.
Yeah, it seems like Binance was referencing their own market prices as a way to gauge the value of collateral, and it was actually the on-chain applications like Aave that were either hard coding it to the value of USDT or were using some kind of read-only API provided by Athena as kind of like the first line of defense. And then if that broke down, which it appeared that it did not, then would they kind of rotate over to an oracle that references market pricing?
But that was Aave, right?
Yeah, Aave, and there might have been a few others.
So, but Aave's hard code is what kept it from depegging, right? And the story I've seen is that Binance was coding it to its own order book, and so when sales went through on their order book, it caused a depeg there on Binance, which then led to liquidations there on Binance, and Binance, the largest exchange in the world, so many other venues effectively were affected after that. I mean, I don't know. This is the closest I've seen to a viable explanation for the actual source of contagion.
Yeah, Aave performed extremely well. I think they had about 180 to $200 million worth of liquidations in only like an hour and a half, 2 hours. No bad debt buildup. Seemed like the app held up extremely well.
I think time and time again we see like robustness of DeFi and these super high stress Three Sigma events. It can be to hard coding on Aave, it can be to liquidation mechanisms. But I think, we saw Binance circuit break in basically every sex. On Hyperliquid, the flow of funds I think is quite interesting when it comes to liquidations itself. So you basically send a liquidation to the order book in a healthy perp market, and you take the other side of the trade, and that's natural, and you get natural buys that are lower than normal and sells that are higher than normal, and so you potentially profit. Then if that kind of gets exhausted, it moves to this kind of internal vault that basically every perp dex has now, and that's called HLP, Hyperliquid Liquidity Provider, that has several children vault that kind of isolate risk. And that basically takes the other side in terms of market making. But that's only 1% of total volume on Hyperliquid today. or it backstops liquidations upon exhaustion. Now, if both of those are exhausted, then you're in a tough scenario, and you kind of have to pull the safety lever, and that's ADL or auto deleveraging. Every perp dex has this because you can't just shut off a permissionless system. And the idea here is that you forcefully close others out of a position that are potentially winning, because there's no one else to take the other side of the position. And a perp dex is a bunch of cash that's sloshing around the system, synthetically tracking prices and risk margining, etc. And so you need, for every long you have, you need a short, and vice versa. And so when you don't have the opposite position, ADL forcefully closes a position. I actually think it's a really elegant design to solve a lot of parameters and constraints that you have with a permissionless 24/7 DEX where you can't just circuit break. And so while it's frustrating for a lot of traders that they're forcefully closed out of position, this happened really nicely and was one of the only perp dexes that didn't get shut off. Now, while that's the case, spreads widened, and this generally happens when there's a lot of vol, and people were frustrated on how ADL actually occurred. But this is literally one of the only places you could trade for the time being at a time. And so I think that was kind of that was the synopsis on Hyperliquid, at least.
I mean, I'm curious. I've seen a lot of debate on Twitter talk about, how do you decide who gets the AD, like who gets auto deleveraged, and like how do you do that in a fair process? It appears in this instance, it's come out since that Athena had actual agreements with exchanges like Hyperliquid that they would not get auto deleveraged, which was a saving grace for a lot of the space. But then, you talk to a lot of traders who were either not aware that this was even in place, or if they were not able to, they felt, to get out of their longs as they were getting closed out of their shorts, and as a result got liquidated. So I do think it definitely raises some questions about, how do you design these systems in safe but also fair ways? And then I think there's also been a lot of discussions about, at what point do you go to socializing losses versus, using auto deleveraging? And here it looks like the two kind of comparative models are Hyperliquid and Lighter. And, obviously in this case, Lighter did not quite perform as well.
I also think this brings up another interesting point, which is like Athena more broadly. I think Athena has single-handedly saved DeFi, like let's say non-Hyperliquid-esque. But it's a double-edged sword where I think it's significant keyman risk. Like back of the napkin math is that Athena generates 80% of yield on mainnet. That's like a scary number, and that's because of leverage on both Spark, Aave, and other platforms. But in an instance where there's a high stress environment, like Athena is key man risk. We need to I think this brings up discussion around okay, are we sidecarring a lot of high stress environments? So Athena gets hard coded. We can have APIs directly plug into proof of reserves. What does all this look like? I think is something that needs to be developed and kind of investigated more deeply, because in a liquidation cascade, if any of these things triggered Athena severe depeg on chain, I think things would have looked much, much different. And perps are going to be margined with Athena too now, right? So that adds a host of other contagion.
Yeah, I mean, I think there's $7 to $10 billion worth of Athena direct and Athena adjacent assets just on Aave alone. So I mean, if we're making the assumption that 20 billion was wiped out on sexes and elsewhere, that number could have gone up by as much as 50% more. And then who knows what the knock-on effects of that are sort of on chain. Could have gotten ugly.
So we had CoinGlass said 20 billion in liquidations. Like I said at the top, I've seen estimates of 30 to 40. No one really, I guess, quite knows, because the centralized exchange liquidation numbers are just self-reported, right? And so it's not, just like their volume, it's not clear that whether it's accurate. But what would you guys guess? We entered this meta recently, the last maybe 2 months in particular, where perp dexes themselves were literally the meta. It used to be meme coins, and then it was what? Now it's launch pads for meme coins, or dozens popping up. And then now Hyperliquid success led to Aster and Lighter and all these other sort of copycats. And you sort of tell in the space that the thing to be doing is trading perps, right? That's the thing to be doing right now. And so it doesn't surprise me that you get a leverage wipeout when everyone's trading perpetual futures, generally speaking, right? You had a spark like Trump with a tariff tweet. I mean, we're all pretty familiar with that. And pretty much the whole space is what? Levered long alts. What leverage ratio would you guess the average was for the entire space? To be clear, we don't know the answer. I don't know the answer, but how levered were people? I'm going to guess like 20 to 50x on average.
I was thinking it was lower because we saw in this case, if in terms of like leverage that got liquidated, I was thinking it might be lower just because we saw like even if you basically had like 2 or like 1.5x leverage, you were at risk here, and I would think that that would account for the majority of actual notional size. But in general, I would say, yeah, I bet if you're trading smaller size, you're probably 20 to 50x. And I mean, Jupiter Perps just introduced 250x. So
Yeah, it seems like you play in the fire, you're bound to get burned. But yes, you're right. There were some drops in the alt space. I mean, like 50 to 75% drops. Leaving aside Atom, the Cosmos coin.
Atom went to zero.
Atom went all the way to zero briefly. It does tell me too that just people under own Bitcoin in this space. This was a lot of leverage on alts. That's what people have been doing. And if you're comfy in spot, to be clear, you cannot be liquidated, just in case people aren't aware of that, right? These liquidations only happen when you are leveraged long or short, right? You're borrowing against your position to trade more, right? So, I mean, I don't actually know if this was the largest by percentage of crypto market cap. It's hard to get good liquidation data. I think it's possible it was. It was absolutely the largest in notional terms. But I have to say, sitting around on my couch, not at Fidelity on March 11th and 12th, 2020, that deleveraging that saw Bitcoin drop from like 6,500 to about 3,000, even a little bit less in just an hour or two, felt much scarier. That felt like if you came in to buy Bitcoin there, you were crazy. And anyone who did was obviously handsomely rewarded. But this is, I haven't looked at the entire alt space, but, Bitcoin's trading as we record at 10:23 on October 13th, around 115K. It's below where it was on Friday afternoon, but, Bitcoin crashes to 115K, right? Like it doesn't feel like existential the way people feared it was back in March 2020. So even if it was the largest notional amount, like by percentage of total crypto market cap, I don't think this was the most serious deleveraging, we'll say that, or the scariest. But it was, I mean, I literally fell asleep on an airplane for about 20 minutes when Bitcoin was 120K, and I woke up and it said 108 on my phone. So that was frightening.
Well, yeah, I mean, I think the whole story with this one is it was just mostly driven by the auto deleveraging mechanisms of all of these dexes. It wasn't necessarily just like a huge macro event like COVID where the entire country shut down. So like this was mostly like a technical thing from my view, and not so much this like huge macro event. Even though like Trump tariff tweets have historically caused volatility, like it just seems like this was mostly exacerbated by a technical mishap.
Yep, and
in the architecture of these applications.
S&P 500 up 1.5%, Nasdaq up 2% as we record on Monday morning because Trump later walked back some of this tariff talk pretty extremely. Talked about how much time there is until the November 1st deadline, so that President Xi is, I forget the exact language, but a smart man and stuff. And so it seems like this is not going to play out like it did on Friday afternoon.
Taco is back.
Taco is back.
I didn't say it. All right, let's move on. Polymarket, one of the largest raises in history in crypto, raised $2 billion from the New York Stock Exchange's parent company. What does this mean for Polymarket, Zach? I know you've been following prediction markets and Futarchy for a long time. I mean, first of all, that's an enormous sum. Love Arjun to weigh in too about what in the world could Polymarket be using this money for? Start there.
Yeah, it's a great question. I mean, earlier this year they had acquired a US based derivatives exchange. I think it was called QSEX for like 112 million. So I mean, they could potentially use it for acquisitions to kind of make the product better. I mean, the investment from ICE, I think, kind of just brings it close to the US. So maybe they don't need to make as many sort of strategic acquisitions like they had in the past. But yeah, I mean, this is a huge vindicating moment for not just Polymarket, but prediction markets in general.
Yeah. I think I have a simpler answer, and I think this is kind of similar to perp dexes, where I think this will be a war of attrition in terms of incentives. And so whoever has the largest balance sheet and the most money is going to win in terms of incentivized build out of apps around the ecosystem, dev tooling, creating grants for developers to build on Polymarket, along with like actual incentives for usage, LPing, market making, etc. And I think that's what we're going to see. I think Kalshi I'm waiting for the next shoe to drop in terms of large raises here. And I think it will be a war of attrition.
Well, I think Kalshi raised at 3 billion a few days afterwards. Is that right? But also, I was at a wedding this weekend and talking to friends who use Polymarket for sports betting, but they're not familiar with the crypto side at all. And I said to them, I was like, "Do you guys know you're probably going to get rewarded with an airdrop at some point?" And I mean, they had no idea what I was talking about, but it really made me think like it's going to be a very interesting cultural moment for like the first non-crypto wide airdrop to get released and see how people react to that and whether or not it starts to kind of click for people, how kind of incentives work in crypto and the whole token model versus what they've been used to, especially a lot of these people who are on like DraftKings and stuff like that, where what they're getting incentivized with is basically like free bets instead of like a token that has liquid value.
Yeah, you're talking
And
about
can you
the
actually
potential
make
for a
money from gambling?
you're talking about the potential for a poly token, right, Lucas? And
Yeah,
I think
sorry.
I
Yeah,
think
exactly.
it's quite interesting. And I should have said this at the top, but the raise apparently reportedly values Polymarket at 8 billion, which would make it one of the larger crypto firms in the world. Yeah, the poly token, this could be quite interesting, right? And it actually raises similar questions to like a base or coin based token, which is to whomst would these tokens get airdropped? I mean, are we talking about users of the New York Stock Exchange or other of ICE's clients might eventually get to participate, or Coinbase shareholders if Coinbase releases a token? Would be very interesting. I don't think we've ever seen a sort of traditional airdrop, but by the way, you can, I believe, airdrop stocks. That actually is possible. Robinhood has given away stocks when you sign up for their an account, and not even their own stock, right? Just like giving away stocks. So I don't think it would necessarily be unprecedented, like in the sort of traditional world, to give away. Not that Poly would be equity, but to give away these types of assets. But yeah, it would definitely be the first crossover. I mean, how might that play out? I mean, that could be. I don't know. I mean, we don't know what ICE wants to do with this. I guess before we get further into token, let's talk about ICE. So, Intercontinental Exchange and the New York Stock Exchange, and basically all of these traditional stock exchanges, they make most of their money on data. They sell their data, right? They sell feeds of pricing and other things like that. I am buying it. I've got my Bloomberg open. Some of the data I have in here, I have to pay for from the exchanges. Polymarket's been widely cited across traditional news media, financial media for its predictions during the elections, for example, and other events. Is that the play here, that ICE is going to maybe bring in some poly data into their traditional data offerings?
Yeah, I think so. And I mean, there's been like some debate on what that data might look like, but broadly, I think you can look at prediction markets as having inputs, which are money going into the markets to trade, and then outputs, which is like the yes no signal. I tend to think the emphasis on their integration of the data is going to be on the output side. Like, what is the probability Donald Trump gets elected? 97%, and less so on the individual trades. Because, like, when you see on MSNBC and other places, when they reference these prediction market values, it's always like the percentage odds. There's effectively zero attention on the inputs or like the actual trading side. So I tend to think that the emphasis is going to be on the outputs of these markets and less so on the inputs.
All right, let's move on to the new ETFs that are coming. Once the government opens back up, that's the big caveat. There are dozens and dozens of ETF applications on the board for the SEC to approve. So even more now, potentially, or more easily coming after the approval of the generic listing standards, which we wrote about a couple months ago. But the government is shut down. So the SEC, unless you work in national security, basically, you are not fully working right now in the U.S. government. There are things like accepted and exempted employees, but most likely, and my understanding, and I haven't interrogated the entirety of the SEC's shutdown plan, which you can see on their website, sec.gov, but most likely these are delayed now. They had been expected as soon as this week. But in any case, Lucas, we're about to see what, like, ETFs representing maybe a dozen crypto assets hit the market.
Yeah, it could be, and it could not only be ETFs representing a dozen, but a dozen ETFs for each asset. So, we could see hundreds of ETFs launching. Um, Competition is going to be fierce. And I think, we talked about this in our newsletter. I think for me, this is one of those moments where now quality and fundamentals are really going to start to matter for these individual launches. Obviously, hype will, maybe drive some short-term momentum and flows for some of these assets, and in an up-only market, they maybe see some flows. But in terms of these serving as long-term vehicles that accumulate the underlying, I think this is where projects are really going to need to start showing, hey, not only are we just like a crypto token, but we facilitate real activity on our network, and that activity is going to be sustainable and lasting. And so I think the big names that people are really looking at right now is mostly Solana, which is, I think, kind of often put as this big three with Bitcoin and Ethereum. But that said, I do think it's going to be a challenge. I think we saw already with the move from the Bitcoin ETF to the Ethereum ETF, there's a pretty big drop off in flows. And Solana is a much well less understood asset than either of those. It's going to require a lot of education. At the same time, I will say it is one network that, consistently leaves in terms of DEX volumes, network fees, application fees. So there is a good growth story there. It's just going to require a lot more education and proving that, it can break out of this, I think, TradFi perception of it as just a meme coin chain.
Yeah, I mean, I think the education curve is going to be quite steep, especially at the L1 asset level, because the differences between all of them are inherently technical, which is kind of where the disconnect between crypto native circles and TradFi circles kind of disconnect. So yeah, I think the education curve is going to be really steep, and we're likely to see a similar dynamic between the Bitcoin and the ETH ETF kind of translate from ETH to L1 X, Y, and Z. But yeah, we'll see what happens.
Yeah, the other assets that we expect will have ETFs approved soon: Doge, Bitcoin Cash, Litecoin, Chainlink, Stellar Lumens, Avalanche, Shiba Inu, Polkadot, Solana, as mentioned, Hedera, which is HBAR, Cardano, and of course Ripple XRP. Do you think any of these are going to get big institutional adoption? I agree. By the way, we ourselves, we should say, have called Solana the third chain. That's what we called it at the beginning of the year. And I think at the beginning of last year, we called it that, to be honest. But also, we continue to believe that. I think the not just the market valuation, but the activity bears that out. Hey, no BNB on here, which, by the way, BNB shot up to like the third most valuable crypto asset last week. I think even it eclipsed Tether. But do we think any of these? I mean, is Wall Street going to be rushing? Wall Street or retail, I should say, going to be rushing to like a Bitcoin Cash ETF?
I mean, I'm an optimist, so I believe that these things have value. I believe that these networks long term, or not all of them, but some of these networks long term are here to stay and
You
are
believe
going
Bitcoin Cash has value, Lucas?
You don't know I'm a big BCH guy.
Oh
And
God.
then, and I think one other interesting component here is the staking component. So
Yeah.
even if you struggle to understand the value proposition of the network, we have seen that adding a yield component to these tokens and offerings can be very compelling for TradFi investors. Just as a way for them to basically trade the asset and do it in a way they feel more comfortable. So that can kind of be a spark that gets the foot in the door and then gets them to start learning more about it. And so if staking really is included, which by all indications it appears to be, I think that will be a boom. And then one other thing I think is interesting, I was listening to James Seyfert from Bloomberg talk about this, is these actually might just be kind of like standalone ETFs that come out, but they do set the stage for basket ETFs to start coming out. And so while individual assets might not be so attractive or a little bit difficult, I think baskets of assets are definitely going to be things that will attract flows, especially in environments where crypto as a whole is doing very well.
Yeah, that's going to be interesting. The like index ETFs that contain these assets. There are. I won't get too specific because I'm not an expert, but I know for a fact that holding a bunch of commodities in a basket, it has major tax implications for the issuer. for rebalancing. So you honestly, to the point where I would think it's prohibitive. However, you could then create a 40 Act fund ETF that holds the ETFs, which are themselves securities, and get around that. So I think you're more likely to see a widely adopted basket that holds some of these assets. In fact, not these assets, but these new ETFs that represent these assets, than you are, I think, to see like a sort of a pure index that holds the commodities themselves in proportion. It's the rebalancing that causes major tax problems in a grantor trust, which is what all the commodity ones are. But you wrap them first in the ETF wrapper, then you build the index. One other thing about staking to mention, I think that is worth mentioning news-wise, is that Grayscale's 2 Ethereum funds, I think, are now already offering staking. So that's ETH. Yes, they own the ETH ticker. I think they own the BTC ticker also. Really squatting on that good domain right there. ETH and then ETH-E, and I forget which does which, so don't hold me to this, and it's certainly not financial advice, but one of them is staking and will reinvest the earned rewards back into the fund's AUM, and the other will distribute them as dividends to shareholders, which is really quite interesting. I mean, I guess this is what we expect, right? I mean, you're going to have one or the other. I think they're potentially both interesting. I suppose the tax benefits are probably better if it reinvests it for you, because if you get paid a dividend, that would be a taxable event. But it's coming. Staking is coming.
Staking is coming.
Yeah, I mean, I think the one thing people aren't talking about enough with the staking ETFs is like it's kind of a double-edged sword where the more successful the ETF is, the more is staked, the more you actually detract from on-chain liquidity. Which I mean, chains already struggle with today. Like I think Solana's like 65 or 70% staked. Like what happens if the ETFs absorb another 20% of supply and it's all staked? Like you're looking at 9 out of every 10 coins on the network being staked and locked away forever. And those will likely never touch the blockchain, at least in their native form. So I think we need to start considering kind of the knock-on effects of this and what it means for DeFi development in the absence of other permissionless sort of assets that can be
on-chain versus TradFi, basically, right?
Well, and
yeah, essentially.
And we're actually already seeing a dynamic like that kind of play out with BN Sol, which is the Binance liquid staked offering, where I think they've recently jumped to about 20% of all liquid staked Solana, and almost none of that is deployed on chain. Because people are just using it on the SEX, but none of that liquidity is then actually flowing on the Solana chain itself. So we are already kind of seeing these dynamics play out.
Yeah, one final, I guess, I think I said this last time. One final thing too to note about staking, right? I would think that having it locked away forever, that means a lot less on like a native DPoS chain like a Solana, where you can without an exit queue, right? Where they can come in and out quite more easily. I guess Ether may be the only one, Ethereum, that has this like giant exit queue dynamic. Am I wrong to think that we expect Solana ETFs and or others, AVAX is one too, that I'm not sure what the staking dynamics are there, but Solana ETFs are likely to be able to stake much larger percentage of their holdings than Ethereum ETFs, given the staking queue dynamics?
I think that would make sense, and I think part of what's going to enable that is we've seen really extensive lobbying efforts throughout the Solana ecosystem. There's the Solana Policy Institute now, and then also Jito, which is a leading liquid staking provider on Solana, have been they've written memos for the SECs. They've been in meetings with the SEC trying to really convey the differences and why Solana is a safe place to stake and for the ETFs to use to stake.
Yeah, shout out to Kristen and Ryan and others at SPI and Rebecca Redditt at Jito. Reddick, a great lawyer. All right, let's move on. Last big topic here: Salomon Brothers dust attack! Exclamation point. A huge report that Zach here and our colleague Will Owens published last week details a truly curious case of, I'm going to say, just spamming. I mean, it's message spamming. Messages sent to UTXO, so pieces of Bitcoin, totaling 2.3 million Bitcoin, right? Which is, one tenth of effectively more than 1/10 of the entire Bitcoin supply, which is almost 20 million at this point. With a message that says legal notice. We are taking constructive possession, quote unquote, of these coins. If you do not move them or notify us that you actually own them and that they are not, in fact, abandoned. You have 90 days to. Well, actually, there is no ultimatum. We don't know what they plan to do, but you have 90 days, is what they say, to notify us that you own them. We looked into this at length, talked to some of the representatives for this Bitcoin transactor that sent all of these. Zach, maybe, and I know this is a giant 30+ minute read report. I encourage people to read it on our website at galaxy.com/research. But Zach, maybe you can give us the TLDR somehow.
Yeah, I mean, the TLDR is they just essentially drop these like quasi legal notices on almost 40,000 addresses saying, prove you own these coins, or we're going to take some legal recourse that may or may not give us, quote, constructive possession. I don't know. The whole thing was kind of odd. Honestly, there were some inconsistencies with the kinds of addresses they targeted, given their stated message of this being a sort of altruistic effort to save the Bitcoin network from what they call a technological attack, likely kind of alluding to quantum vulnerabilities that have been like widely discussed. So like they targeted a lot of P2PKH addresses and not P2PK, which are most commonly thought to be the most vulnerable. So like, there was like that whole element, and then in their messaging about like the altruism of the whole thing, they then kind of stake claim on individual possession, like our client will take constructive possession in the actual messages that were dropped to addresses on chain that were much harder to access for the average person. So there was kind of like a bifurcation in the messaging, and then a bifurcation between the messaging and their actual actions. So whether it's like due to ignorance or they just have some ulterior motive, it's kind of hard to tell based on what we have. But yeah, the campaign was massive.
Yeah, and the website that they linked to, like the notice, was hosted on a website, salomonbros.com, which is it's not, but there once was a famous storied investment bank, Salomon Brothers. And apparently this is the successor to that investment bank. Now, we talked to them, Salomon Brothers, and they claim to be the continuation of that bank. We found news stories that suggest actually that some party or group of people bought the IP of the name and sort of have restarted it. But what do we think the end game is here? I mean, because this is, again, like if you're holding your Bitcoin in cold storage, like people can spam my addresses with whatever they want. Like, doesn't matter to me. Or does it? I mean, what do we think they're going to do here ultimately? We know what they say. They claim some sort of altruistic protection of the network. That, unfortunately, and I don't mean that I disagree that's what they're doing, although I do. That just doesn't make any sense. Like, it just literally doesn't make any sense at all. Like they were saying, protect from North Korea, and we're like, these messages or any further follow-up would do nothing of the sort to prevent North Korea from hacking someone, right? What do you think is going to happen here?
Yeah, I mean, there's a massive enforcement gap between what they're claiming they want to do and what is likely to actually happen. Like if I'm holding my Bitcoin in a Trezor, like you can have some kind of weird off-chain claim on it, but if the coins never hit a centralized exchange or I just never move them in general, like there's really nothing you can do about it. But yeah, my guess is they're gonna and it's going to be difficult because every single jurisdiction kind of has their own rules around this, and it's not just like a blanketed like, oh, these coins are abandoned, I want to lay claim to them. Like I just do it once and it's done. Like if you wanted to cover the entire United States, one, every single state would have to have a law in place for this, and two, you would have to go state by state and kind of take the same action across the board. um but yeah, I mean, I think that there's going to be efforts in at least a few states where their actions and notices actually like kind of lined up pretty well with the law. And then I think it's going to just be a waiting game. Like this isn't going to be something that they just do and then it immediately hits. I see this being a multi-year thing where it's like, oh, we identified this address, it's abandoned, we'll lay a claim on it, and then if the coins move to somewhere where we can actually take up some action, whether that's a centralized exchange or a centralized custodian, I think you can get kind of tangled up, or individual users can get kind of tangled up in it from there. But yeah, the enforcement gap is massive. Tracking this stuff too is going to be very difficult. Like I can move coins and then move them to a centralized exchange. Like how do you prove that the address in between was still me or not? So I mean, I don't think they'll be able to touch nearly as many coins as they kind of dusted. But nonetheless, I think this is definitely something that will have some kind of follow up, or at least an effort to follow up.
How much did these guys spend in total? Like, was this like a expensive cost, or are they going to recoup any of what they spent to do this?
I mean, the fees spent are gone. I think that was like between like $60,000 and $70,000 worth of Bitcoin. And then obviously the little bit of dust that they spent on each of the 40,000 messages is also gone, which I think equated to about another quarter of a Bitcoin.
Okay.
Tracking the flows was actually quite difficult. One, it was the first time I actually did like a super detailed analysis on a UTXO chain like Bitcoin. And two, like they were clearly sophisticated, swapping out change outputs. So instead of reverting unused coin back to themselves, they sent it to another address that was then used to kind of send messages and kind of mask the funding flows of the entire program. So like clearly these people knew what they were doing. But yeah, I was only able to find about, I think like $1,200 or $1,500 worth of Bitcoin that they recouped at the end of this. So I think we can make the assumption that close to $85,000, $90,000 worth of Bitcoin are gone. And then, I mean, maybe they were able to recoup some on the back end that was just very difficult to sort of track, just given how elaborate the transaction flows were.
Yeah, it seems a little Craig Wright-ish to your point, meaning that like I think the expected outcome is lawfare, right? It's get some jurisdiction somewhere to say that these are in fact abandoned, and then just take that court order, maybe they themselves, like we're going to be doing, sitting on these coins on block explorers, in their analytics, and say, oh, the coin just showed up at Coinbase, like mail Coinbase a letter with the jurisdictional order, right? And try to get Coinbase to freeze or give them over. But the funny thing is too, is just the act of moving them in the first place would seem to prove they aren't stolen. And
They're not.
they're not abandoned. and also, right. So like, even if they do show up somewhere, and then second, like, even under the most sort of like, I don't know, charitable of abandoned property laws, it is true, by the way, like if you leave stocks on a brokerage account and you never log in for years, eventually in most US states, the brokerage will actually escheat them. It's a strange word, escheatment, to the state, right? And then often there's a long period of time thereafter where you, the owner, could go to the state and say, oh wait, those are mine, right? And there are actually websites. I mean, I've seen the people say to do this online, and I've done it myself. We can go and put in your information and see if maybe there is some assets that the state is holding on your behalf that are abandoned. But the thing is like, even now, that's when they're held at a central intermediary, right? These types of laws, and including any addressability here, would require that there's somewhere to send the letter, right? I can have gold under my, mattress, and you can mail me as many letters as you want saying, hey, that gold's abandoned. And it's just fundamentally not abandoned. It just is not abandoned, right? Inert in my wallet is not abandoned, right? So, and there may be like state laws or laws that say that when an asset or something is lost for X amount of time, it becomes abandoned. But like, if it isn't lost, then it doesn't count. Like, so just, they're sort of just guessing that, I mean, some of the addresses that you found, Zach, had only not moved in 5 years. They're not even that old, right? And I've got coins that I haven't moved in way longer than that. So you're allowed to just own things and not move them. Like, it's totally allowed, right? It's just a strange, quixotic. Yeah, it's a very, quixotic type of thing here. And it's just very, very bizarre.
Yeah, I mean, they might have been trying to compensate for that too. At the bottom of the URLs that they delivered to people on chain, there was actually a form that allowed you to input like your name and address and all of that stuff. So like if you kind of wanted to prove ownership or prove that you like have abandoned coins without actually moving them on chain or having access to the keys, you can turn over your personal information to them, which was like equally, or I guess it was like viewed equally in their eyes as proving that they were abandoned. So, I mean, from the perspective of the addressability stuff,
Well,
like they even maybe trying to go from that angle.
Most of these notices went out in July and August, right, Zach? So when is 90 days? When is the sort of first, when if something is going to happen, what's the earliest that we might see it happen?
For the first cohort of addresses, it was actually last Friday, October 10th.
Yeah.
And then November 5th. I have not seen any sort of follow-up from
Friday, October
anybody.
10th. Is Salomon Brothers to blame for the leverage wipeout?
Yeah, I don't know. There was also people tweeting that like October 10th and November 5th were were days to watch. They mentioned that honestly like a couple days after we released the report, so maybe some folks
Yeah.
saw it and referenced it, but
I already turned over all my Bitcoin to them. I don't know what you guys are doing.
Well, it is a curious case. I encourage people to read that report at galaxy.com/research. Before we wrap, what are you guys following just for the next few days, or what's on your mind at the moment here in crypto?
The Futarki Umbra raise that we had mentioned last week was wildly successful. I think when we recorded, they were only about an hour into it. They had raised $3 million. It closed out over 150 million. So yeah, I think maybe one of the biggest on-chain raises of this style ever. And I think everybody only got about a 2% allocation. So if you put in $100, you only got 2% or $2 worth of allocation to the token, and then they return the rest of your funds. So wildly successful. And they have another one coming up this week. I believe tomorrow on October 14th. So we'll see if the momentum continues. And yeah, just adding one more Futarki to the list, growing quickly.
I'm looking at Hyperliquid. It looks like is going to release today's October 13th HIP3, which enables permissionless launch of exchanges on top of Hyperliquid using all of their infrastructure. So we've seen already a number of teams are kind of queued up, and securities, private investments. So we're going to see some new interesting assets, I think, being launched on Hyperliquid's infrastructure over the coming weeks. It's about, I think it's five. It was initially a million hype that you had to stake in order to launch a market. I think they've now reduced it to 500,000 hype. So still about $20 million or so to launch one of these markets. So these teams are really investing a lot. And then I think it'll be interesting to see if there's any sort of backlash against USDE after what happened last week. I noticed that I think there was about like a 500 million mint of Sky right after the incident. So seeing if there's flows into other stable coins. And then finally, you're saying perps was the meta. Well, people are already starting to talk about what the next meta is, and they've decided that maybe options is what should be replacing the perps market. So on-chain
We tried
options
this one
coming.
already a couple of years ago. Yeah, we tried that a couple of years ago. On-chain options, they've never really taken off. But yeah, it does feel like crypto is never short of a narrative. Something always crops up to be the narrative. I'm not convinced the perpdex narrative is over, although I do think a
agreed.
lot of people got burned last week. It's interesting. Just before we wrap, too, you wonder who got burned, right? Institutions, maybe some crypto funds, that level of institution got torched a little bit, but TradFi, they're not trading perpdexes, right? They're owning ETFs, maybe doing some spot or lending or something like that, right? And people say, okay, so it was retail that got burned. I really like Jeff Dorman from Arca's framing of this. I know some genuine retail, friends and family that own crypto. They are not on chain. They are not on Hyperliquid, right? Like they, maybe they are have like a Phantom wallet or a Bitcoin wallet, but most of them that I know, sort of in the true retail, are just on Coinbase or buying Bitcoin on Cash App. So it's some middle cohort, right? It's like true retail. The retail masses, they're not on crypto Twitter, they're not on chain, right? So who was it? It's some sort of professional retail, even if they don't have a lot of money, right? But they are trading professionally, right? They're trading deep in crypto tech, and I think all the way up to like pretty high net worth retail is who got burned here, right? Like some people trading with 6, 7, even 8 figures on chain. Right? That's not retail. I don't know what that is, but it's not retail. So some sort of middle cohort here. Also, just it was the alt bloodbath. I mean, was extreme, right? I mean, Bitcoin trading at 115K. Ether got all the way up to 4,200, back at like 4,100 now. Solana almost to 200 again. Like these coins have mostly rebounded, but if you look further down the list, many have not rebounded yet.
Yeah. I mean, I think it could be a nail in the coffin for coins that have been dead for a long time, but have just kind of been staying afloat. And it's really hard to rebound from something like this afterwards. Like Adam, we should watch Adam closely, right? Like what is going to happen with Adam?
Poor Cosmos. Poor
But
Cosmos.
Alex, I do think the people who got hurt the most, I think, are it's the crypto degens, and they have made a lot of money over the past 2 years. And I think that is what is so painful if you look on crypto Twitter right now, is a lot of these guys and girls are going into this period thinking this is kind of the end of the cycle and when the craziest great gains are, but also where the most risk is. And
Yeah.
I think a lot of them just saw what that means, really.
Yeah, they got torched, and if they hadn't been taking gains, I mean, I've seen stories on Twitter of people like, oh, even some people I saw said I had made $30 million and lost it all. What are you doing with your entire
Sorry, I
net
shouldn't
worth
laugh.
sitting in collateral against leveraged perps positions? I mean, that's crazy. People, please be careful and you know, a little bit less risk averse. I would say that's, you know, that would be prudent based on some of the stories we're seeing on crypto Twitter. All right, that's it. That's everything for Galaxy Grid this week. We'll see you all next week. Thank you, Lucas and Zach, and everyone have a safe and happy weekend. We'll catch you next week.